Welcome back, Focus Learners. Today, we're diving into another explainer, and we're tackling one of the most fascinating and frankly, universally misunderstood mysteries of corporate accounting. Have you ever looked at a massive company's financial statements and just wondered, how on earth can they report millions in profit to their shareholders, but then seemingly owe just a tiny fraction of that in taxes? Well, I promise you, it's not just loopholes or magic tricks. It's actually a highly structured set of rules. So today, we're breaking down the core logic of ASB 112, which is the accounting standard for income taxes, to see exactly how this whole thing works behind the scenes.
So, let's start with a really crucial, kind of provocative question. Why does the profit on a company's balance sheet almost never match the profit on their tax return? Think about that for a second. This right here establishes the central conflict we're looking at today. We are essentially dealing with two completely different rule books that are both trying to measure the exact same business performance.
Okay, let's dive into this. Under standard accounting rules, we calculate what's called accounting profit, and this operates on an accrual basis. That basically means you record revenues when you earn them and expenses when you incur them, totally regardless of when the cash actually changes hands. But conversely, taxation authorities, they operate in a totally different reality to determine taxable profit. They largely just care about cash, when cash is actually received or paid out. And because these two frameworks use completely different timing rules, a massive discrepancy opens up between the two profit numbers.
To systematically unravel this mystery, here's our roadmap for today's explainer. First, we'll define the income tax problem. Second, we'll look at the core logic of ASB 112. Third, calculating current tax. Fourth, we'll introduce the concept of deferred tax. And finally, we'll walk right through the 4 deferred tax steps.
All right, let's kick things off with Section 1, the income tax problem. Accounting versus tax.
We really need to understand how everyday business transactions trigger wildly different timelines when it comes to taxes. Because, as you'll see, not all transactions are treated equally. First up, some transactions have absolutely no tax consequences at all. Take entertainment outlays, for example. You might spend $18,000 entertaining clients, which is totally an accounting expense, but the tax authority is going to tell you that's a permanent difference. It will literally never be tax deductible. Second, you have current period consequences only, like paying $10,000 cash for rent today. The expense and the tax deduction happen at the exact same time. Easy peasy. But that third bullet, that's where things get super tricky. Transactions with both current and future consequences. Imagine you've accrued $21,000 in interest revenue for the year, but you've only actually received $15,000 in cash. Accounting says you made $21,000. Tax says, nope, you only made $15,000 today, and you'll make the rest later. Accounting for income tax has to seamlessly track all of these different timelines.
Moving right along to Section 2, the core logic of ASB 112, the principal issue.
Now, before we dive into the heavy calculations, we need a philosophical anchor. Now, what's really interesting about this slide is the heavy emphasis on the word recognized. You see, ASB 112 bridges the timeline gap with a very strict philosophy. If a transaction happens in the current period, its tax consequences must be recognized in the current period's profit or loss. It absolutely does not matter if the actual tax is paid today, tomorrow, or 5 years from now. You always match the tax consequence to the accounting period where the transaction originally occurred.
Let's jump into Section 3, calculating current tax. Current tax liability.
With our philosophy established, let's solve the immediate problem, right? Calculating the current tax owed to the authorities right now. And the foundational math here is actually incredibly straightforward. Your current tax liability is just your taxable profit multiplied by the current tax rate, which for our examples, we'll just say is 30%. But the trick isn't the multiplication. No, the trick is finding that taxable profit number in the first place. Because we aren't starting from scratch, we have to manually adjust our accounting profit to satisfy those strict tax rules.
We do this using a 3-step current tax worksheet. Step 1, you identify your accounting profit. This is your starting point because it already contains all your revenues and expenses for the year. Step 2, you comb through your ledger to determine exactly which expenses and revenues are treated differently by the tax authorities. And Step 3, you adjust. For example, if you have an expense for doubtful debts, accounting recognizes that expense immediately, but the tax authority, they won't let you deduct it until the debt is literally written off as unrecoverable. So, for the current tax calculation, you actually have to add that doubtful debt expense back into your profit. You get the tax deduction in the future for sure, but for today, your taxable profit goes up.
So if we are adding things back now to get a tax deduction later, it begs a pretty massive question. What happens when a transaction's tax effect actually happens in the future? We've resolved the now, but how in the world does accounting handle the later?
Which brings us perfectly to Section 4, the concept of deferred tax. Future consequences. Deferred tax is basically this ingenious mechanism accounting uses to handle transactions that have future tax consequences, like those doubtful debts we just talked about or depreciation. To calculate it, we have to look at our balance sheet from two entirely different viewpoints. The first is the accounting side, which gives us the carrying amount. The carrying amount is simply your asset and liability balances after things like accumulated depreciation and doubtful debt allowances have been netted off. This is the reality according to the accounting rulebook, and it's super easy to read straight from your end of your trial balance.
But then, we have to contrast that with the second viewpoint, the tax base. This represents the exact same assets and liabilities, but viewed strictly through the lens of the tax authorities. For example, your accounting carrying amount for a piece of machinery might be $60,000 because of how you calculate depreciation. But the tax base? That might be $75,000 because the tax office uses a totally different depreciation schedule. Deferred tax lives right there, in the gap between those two numbers.
And finally, Section 5, the 4 deferred tax steps, the 4-step process.
So, how do we systematically process that gap? Let's move to and see how this builds. We use a highly procedural 4-step framework. Step 1 is determining your carrying amounts from your accounting records. Step 2 is calculating the corresponding tax bases according to tax legislation. Step 3 is comparing the two to find what we call temporary differences. And finally, Step 4 is calculating the deferred tax adjustments that will actually go into your journal entries for the year.
Step 4 reveals an elegantly simple matrix. Basically, when the carrying amount and the tax base don't match, they create a temporary difference. If that difference means you will have to pay more tax in the future, meaning your future taxable amounts are greater than your future deductible amounts, you have a taxable temporary difference, and that creates a deferred tax liability on your balance sheet. Conversely, if the difference means you're going to get to pay less tax in the future because your future deductibles are greater than your future taxables, you have a deductible temporary difference, which generates a deferred tax asset. It is just a brilliant way to track future cash flows to the government.
But wait, there is a massive, absolutely crucial caveat here regarding the recognition rules. The standards force you to recognize all deferred tax liabilities immediately, no exceptions. But deferred tax assets, they are only recognized if it is probable that you will have future taxable profit to actually utilize them against. So the key takeaway is this asymmetry in the rules. Accounting standards take a very conservative approach. They force you to declare the future taxes you owe right now, but they make you prove you'll be profitable enough to actually benefit from any future tax deductions you've accumulated.
Which brings us to a final, pretty provocative question to leave you with today. Since tax logic differs so fundamentally from accounting logic, does a balance sheet truly reflect future cash flows without the adjustments of ASB 112? Well, the answer is a resounding no. Without recognizing deferred tax, a balance sheet would be completely blind to the future tax bills and tax savings embedded in its current assets and liabilities. ASB 112 is what brings financial reality to the balance sheet, ensuring that no matter how differently the two rulebooks operate, the ultimate economic impact on the company is captured today. I really hope this explainer has illuminated the brilliant logic behind tax accounting for you. Keep exploring, keep learning, and I will see you in the next explainer.